We're joined by Alan Nuckman, Chief Market Strategist at Bullseye Option. Alan, thanks so much for coming on the show.
Good morning, Andrew.
What's the big theme going to be in early 2022, do you think?
Well, the big thing is I think people are going to come around a bit and realize this inflation scare is just reflation. That a lot of assets have increased in value, but they were at super historically low levels. If you look at crude oil was negative, and now it's been between 60 and 80 now for about 8 months. And, you know, we're kind of in a normal range where we've been in the last couple of decades, and we're holding around the 70 level. So I look at that as a positive. The big thing I take out of 2021 is not what did happen, and a lot of positives happened. We saw the stock market surge, and we've seen a lot of these assets increase in value, which is a good thing, which is what we want. But what didn't happen? We didn't have any, major sell-offs, and every time we did have a correction or a pullback, it did snap back.
So buy the dips worked. At some stage it won't, but it's impossible to know when that's a busted strategy.
Right, and the one way to look at it is, and we've talked about this before, the TINA trade. There is no alternative to stock. Hasn't been for a decade. So if we look at interest rates, which is a hyper focus here in America, and let's talk about this. This is the most predicted rate hike policy in the history of the world. So we're going to get 3 hikes in 2022. We're going to get 3 hikes in 23. That's going to bring the short-term rate, which the Fed can control. That's all the Fed can control. The short-term rate's still going to be less than 2%. Less than 2%. And then there's no rate hikes in the pipeline in 24, 25, or 26. So, that's still extremely, extremely, extremely low rates. But the most important point, it doesn't compare to the yield that the stock market's been giving us over the last decade. So there's still going to be money pouring into stocks, in my opinion.
Yeah, I mean, we are still in this weird situation, aren't we, that dates back to the financial crisis in 07, 08, these surreally low interest rates. Right,
and it's not just us, it's around the world. So, it is what it is, but we've got to learn to take advantage of it. And those who haven't, if you haven't been long, you've been wrong. And looking at some of our indicators, I look at crude as a positive because it's a demand indicator. Look at gold finally breaking out here today, a little bit above 1825. It's been between 1700 and 1900 for the last year. That's really been one group, one sector that hasn't participated. And if I look at the big picture, and I look at volatility in the performance of the market over the last year, the S&P is up 25%, more than 25%. The VIX is down 25% this year, and it's 50% off its highs. And most importantly, it's 25% off the June lows. So that means there's more downside in the VIX, and there's more upside in stocks.
Sorry, just clarify what you mean. There's downside in the VIX, so volatility is likely to drop?
Right. As volatility declines, there's a very inverse relationship between volatility and the stock market. So if you look at the chart of the S&P and look at the chart of the VIX, as the VIX goes down, the S&P goes up. Or as the S&P goes up, the VIX goes down.
You love commodity and resource stocks. Why is that?
Well, I grew up in Upper Michigan. Grew up in the Iron Belt, so I've got a lot of history with the ebbs and flows and the psychologies of the commodities markets. And that's where I started on the trading floor as well. So I really understand that. One play I'm looking at right now is actually in iron ore. We've talked about Cleveland Cliffs in the past, but I'm even more emerging market combination with this because I'm looking at a Brazilian stock, Vale, V-A-L-E. It's trading around 14. It's about 40% off its highs. A lot of these commodity stocks had a surge in the spring, and now they've drifted off. So I like U.S. Steel. I like Cleveland Cliffs. I like Alcoa. But Vale's got a really interesting chart. It made a bottom. It had a great pattern, which I like. And the way I'm looking to play it is a 2023 option. January 2023, so that's a year of time, a $12 call, which is an in-the-money option. And so that's the way I like to play these things. Have plenty of time, and if this stock gets to 18, this option will double. So I use these options not to try and be the smart guy, but just position myself for the long term with a high probability play that fits my lifestyle, that I don't have to watch the markets minute by minute or day by day.
I suppose I should ask you, disclosure-wise, are you long any of those metal stocks, Alcoa, Cleveland, Vale, U.S. Steel?
I trade options in them, but I trade them back and forth personally.
Okay. Do you think at some stage the bill is going to have to be paid for this virus in terms of massive government debt, in terms of businesses that have unfortunately gone bust? Do you think that big bill is going to be a problem for equities?
I don't think so, and I can only follow what the market says. My opinion is just an opinion, and everybody has one, but follow what the market's done. We've made nearly 70 new S&P highs this year. We know what's out there, and the market continues to go, go, go like never before. So the answer to me is I don't think so. And to talk about a bill being paid, you know, we're still having the discussion, getting back to commodities, about the Build Back Better bill here in the United States. Mm-hmm. If this is not the time to borrow money with interest rates at all-time lows to invest in infrastructure, there is no time. So you've got to think about that. The cost of borrowing money now is zero. So that is the time to invest, in my opinion.
Alan, thank you very much. Have a wonderful 2022.
Merry New Year.
Merry New Year. Alan Nachman, Chief Market Strategist, Bullseye Options.